Good afternoon. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we are here with Guy Berger, Director of Economic Research at Burning Glass Institute, formerly of LinkedIn, an analyzer of all things labor market data. Also, my colleague Allison Schrager, Senior Fellow at the Manhattan Institute, Bloomberg Opinion columnist, and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. And we are here to talk about the Fed's decision that is coming to us in just about 5 minutes. The expectation is broadly that they will do nothing. Bloomberg surveyed 110 economists, soothsayers, and 110 of them unanimously expect that they will hold rates in a range of 5.25 to 5.5%. The way this central bank operates is they do not like to surprise markets. They would have some way, somehow, sent up some smoke signals if they were really going to do something today. So I think it's fair to say that the odds of an actual policy move are infinitesimally small. However, it is a significant meeting because, as I said, the Fed tries to be forward-looking. It tries not to surprise markets. And so the logical step, if they are going to set us up for perhaps a cut in September, maybe even a series of cuts, is they would start to hint at that a little bit more explicitly, perhaps first through their statement, which we'll get a look at 2 p.m. in just about 4 minutes, and perhaps subsequently in Jerome Powell's press conference, where our colleagues from Bloomberg News and elsewhere will have the chance to grill the Fed chair a little bit. Getting into this, Allison, let's go to you first. Do you think we'll see some smoke signals from the FOMC that cuts are on the way? What do you think that might look like?
Yeah, I reckon so. I mean, it will be definitely encoded language. I mean, and it's kind of an interesting situation we're in because, according to economic theory, if you do a surprise cut or increase, it has a bigger power on the market. But the Fed doesn't want to have power on the market because if they do cut rates today, it would be very expansionary and possibly they don't want to do that. They just want to take their foot off the brake a bit to keep the economy from going to recession, but they also don't want to spark inflation. So this isn't like they're cutting to boost the economy. So really that, and that's a big reason they don't want any surprises. So we could expect some carefully worded talk about if we continue to see improvement, maybe we'll see some easing. But I definitely think there's no reason why they'd want to surprise anyone.
Okay. Hey, Guy, I've seen you make the point on social media that, we talk too much about the timing of the first cut. And what really matters maybe is how much they cut or where they end up, something to that effect. What do you think we could possibly learn today that might really matter?
Well, I think they're going to be starting to recalibrate policy, to get to Allison's point, which is they're trying to thread a needle where they don't want to rekindle inflation risk, but they don't want to run the risk. They're squeezing the economy so hard we tip into recession. And it's going to be actually hard because they have to talk about how much easing they're planning. And all they can say is we will ease as much as is needed to stay on this narrow path, but they can't pre-commit to cuts. And so I think the market's going to be left guessing. And I think this is going to be true for a while about how much easing is actually going to materialize to stay on that narrow path. And I think there will be possibly clarity on likelihood of a cut next time, but not much clarity on where we're going to be, let's say, a year from now.
Right. Yeah.
Because they can't provide it. They don't know.
100%. And the dynamics are always so complicated in real time. We talk about what the current policy stance is, but for instance, there are some ways in which the stance of policy or the restrictiveness of the economy is changing before our eyes. We've seen yields come down 30 basis points, 35 basis points in recent days, and that's having an effect whether policymakers move in September or not. But in any case, we're looking for that decision in about 5 seconds now. So I'll bring it to you as well as some of the key headlines here. So as expected, the Federal Reserve holds rates at a range of 5.25 to 5.5%. That's exactly where it's been for an entire year now. Headlines hitting the Bloomberg terminal as we speak say the Fed repeats waiting for greater confidence on inflation cut. The Fed says the unemployment rate, quote, has moved up but remains low. No argument there. We'll go to Guy on that briefly. The FOMC remains attentive to, quote, risks on both sides of the dual mandate. We are seeing we are seeing the stock market pull back a little bit on this. Maybe they were expecting some stronger signals out of that statement. I am also waiting for I'm waiting for the strike through version of the statement to come out, so I can give you a little bit more of a detailed sense of what, if anything, has changed there. But Guy, let's go to you real quick on the risks on the employment side of the mandate. This is absolutely your wheelhouse. You are one of our go-to guys on the labor market, and this is a tricky labor market to interpret right now. As the Fed says, the unemployment rate is drifting up, but it's still quite historically low. What are we supposed to make of that, and what are policymakers supposed to make of that?
Well, they're trying to emphasize two things. The first is we're not in a recession right now, and not only that, the trajectory of the economy right now does not look like we're in a recession, but it is moving. I don't know if in the right or wrong direction, because the Fed did expect to moderate, but it is moving in a direction where if it just keeps going, we would get worried. So they're acknowledging that. There's also a part in the statement where they talked about being attentive to risk and inflation previously. Now they're attentive to risk on both sides of their mandate. So there's definitely, like, the way I would think about it is policy now is, if anything, more balanced, or the policy stance is more balanced than it was in today's statement. And I think that's sort of a waypoint to, presumably, if inflation keeps giving them confidence, not my wheelhouse, inflation, like, that they are going to ease to calibrate policy back to Allison's path of balancing these risks. Policy wants to keep these risks balanced. And I think that's what they're going to emphasize when they start cutting, probably, whether it's in September or some other time, that they'll keep emphasizing that. We got to keep these risks balanced.
Okay. And what about this idea of the frozen labor market, Guy, which I've seen you sort of address in your various analyses? I think it's hard to look at this labor market and say it's bad because people aren't getting fired. There aren't mass layoffs. In fact, layoffs are quite low, but there's just very little churn. Not many people on the outside, it seems like, are getting in. Is there any precedent for how you would deal with a labor market like that as a policymaker, Guy?
I mean, in the end, if there's fewer people leaving, fewer people coming in, but unemployment's still going up, the rise in unemployment. In some sense, I kind of view that it's different, but a lot of the key features are similar-ish. And I think the Fed, if the idea is, if hiring keeps coming down, at some point you worry that it falls down so much that employers feel like they have to lay people off. And by that point, you're really behind the curve. So I think the Fed has to, even if the idea is, well, the baseline for hiring is going to be lower than it was in the past, you can't ignore it. If it's still coming down, at some point it becomes a risk. And it's clearly come down enough that unemployment can start drifting up a little bit. So again, I don't think they can discount it, while acknowledging that hiring is going to be lower than it was.
Yeah. Okay. All right. So here's a quick takeaway directly from the text, as my colleagues in Bloomberg News are reporting on the live blog here. So the statement added a qualifier today in the way that it characterized inflation. In June, inflation was described as remaining elevated. Today, they say it is, quote, somewhat elevated. Similarly, in the way that the statement describes the labor market, the Fed says, quote, job gains have moderated and the unemployment rate has moved up but remains low. My question to you, Allison, is like, does it make sense to have the same policy rate today as we had in July 2023? Just to give folks a little context, core PCE has fallen from about 4.2% a year ago to 2.6% as of the latest reading. Unemployment has gone from 3.5% to 4.1%. Just at a very base level, does it make sense to you that we have the same exact policy rate as we did back then?
Well, it depends on whether or not you think the current policy rate's actually being restrictive. It could be argued
Mm-hmm.
that it's not restrictive, it's neutral, maybe even mildly even expansionary, although that's a bit of more of a stretch, and that inflation came down and the labor market, I wouldn't say tightened, but maybe became a little less hot just because of supply constraints that eased or the supply shock that sort of alleviated, and monetary policy hasn't much role at all, and rates aren't still expansionary. I mean, I guess, if you make that argument, I could also be convinced that a quarter point rate cut in September at that point wouldn't do much damage either way as well. So, it depends. I mean, the thing is, it's all very unknowable. As Guy
Right.
pointed out, we don't know if the labor market is just going from too hot to like something more stable, or if it's actually moving into something that could be recessionary.
Okay. All right. Well, let's have a little bit more fun with with the details here. There's not too much to chew on, so we'll run through this pretty quickly. But this is your actual strike through of the text of the statement, so you can see what kind of smoke signals they're sending out. So the statement says recent indicators suggest that economic activity has continued to expand at a solid pace. Seems objectively true based on recent readings of GDP and so forth. Job gains have moderated. That's a change from job gains have remained strong. And the unemployment rate has moved up but remains low. Now that's a change from the unemployment rate has remained low. Then they go on to say inflation has eased over the past year, but remains somewhat elevated. Again, the only tweak there is the addition of the somewhat. And then they go on to say in recent months, there has been some further progress toward the committee's 2% inflation objective. They sub in the word some, they sub out the word modest. And then we move on to the second paragraph. I'll get you right to the nitty gritty here. They say the committee judges that the risks to achieving its employment and inflation goals continue to move into better balance versus have moved toward better balance. And then in the last sentence of the second paragraph, they say the economic outlook is uncertain and the committee is attentive to the risks to both sides of the dual mandate. Now, one final thing that I'll bring your attention to, it's a non-move, right? The sort of core of the forward-looking piece of this statement is in the third paragraph. So if policymakers really wanted to come out and tie their hands, they probably would have done something right there in that in that third paragraph. But that remains unchanged. You continue to have this language in considering any adjustments to the target range for the federal funds rate. The committee will carefully assess incoming data, the evolving outlook, the balance of risks. So that strikes me as a pretty cautious statement. I don't know if you'll agree with me. I thought they would come out and maybe more concretely set the stage for a move in September. Quite frankly, I wrote a couple of columns after the recent CPI report, making the case that they should just go ahead and do something right here at this meeting. There were some other prominent voices, much more prominent than mine, that came out in support of that idea. Bill Dudley, writing in Bloomberg Opinion, said that they should be on the move right here in July. But not only are they not on the move, but they're in no way, shape, or form are they really tying their hands for September. Does that seems appropriate to you, Guy?
Yeah, absolutely. I mean, the way I sort of think about it is like there's been an incremental. The first paragraph talks about an incremental change in the data,
Mm-hmm.
both on the inflation side, becoming somewhat elevated and giving them a little more confidence. Unemployment rate moving in a certain direction. That describes how the data is evolving toward their mandates. The second paragraph talks about how they sort of adopt that into a balance of risk, and how the balance of risk has marginally shifted and is much more like they're now worried on both sides versus being particularly worried about inflation.
Right.
And that shift in the balance is not quite ready yet to have them change policy, which is why the third paragraph didn't change. However, I do think if you sort of think about this in motion, it's not going to take that much more change to those first two paragraphs. They're essentially in a position where if the data in the next 6-7 weeks, I don't remember exactly when the September meeting is,
Mm-hmm.
continues, like shifts, that could move them that would probably move them to the easing camp. So it really depends. How does the next month, maybe, I think we might have some early inflation data heading into the September meeting, what that looks like. And then we're going to have 2 more employment reports. I think that the key part here is that third data dependence paragraph, which hasn't changed. You could imagine data that either gets them to hold off in September if inflation data is not favorable, if the labor market data suddenly firms up. And then on the flip side, if some of that data starts moving a little faster toward tilting the risks in the direction they've been moving, you could see that third paragraph looking a little stronger than just we've eased once and we'll continue to value the data, see if more is appropriate, which I think is probably the most right now my base outcome for that next meeting. Sorry, that was a long answer, but
no, spot on. And I apologize for having taken the statement down just as you were addressing it, Guy. I put it back up for folks. But Allison, to you, like, what are we really afraid of here? I mean, I tend to agree, in part because of my reading of Guy's read on the labor market, that the risks to the labor market in like an imminent recession aren't like screaming in our face. But even if the risks are very, very small, why risk it at all if one thinks, as I do, that this inflation problem kind of feels licked? Like, what are we afraid of here?
Well, I think they're afraid it's not completely licked. And, they don't, I mean, if you believe, and I'm honestly getting skeptical in forward guidance working, and they didn't cut now, but said they were going to cut in September, that's effectively a cut now, because and I think their concern is we're just getting there. We're just about to be able to call it defeat. But like, if we effectively do cut too early, we could undermine that. And so, I mean, if you look back on a lot of recessions in the 20th century, they were caused by the Fed being too slow to cut rates. So I think they're very mindful of that, but they also don't want to go down as the Fed that brought inflation back as a chronic issue. So I think this is why they're being cagey, and these sums, SOME, not SUM, are doing a lot of work here.
Okay. All right. And let me ask you this too, Guy. Do you agree with my sort of assessment that things are pretty fuzzy here, and it's hard to know that we really have the narrative right? Do you think that, I mean, economic data in real time are always hard to interpret, and you can always tell a lot of stories, but there's a lot going on in this data right now. You've got the unemployment rate moving up for reasons that don't have to do with layoffs. Some of it is people coming into the labor market and so forth. you've got some even maybe weather-related noise. My colleague Preston Furriello, who helped me prepare for this conversation, pointed out, we had some Burrell effect in the data recently. Does all of that noise, do you think, argue in favor of let's just wait a little bit longer and see where this is going?
I mean, I was thinking back to Allison's point, which sometimes the Fed has waited too long. I think their perspective is they're aware of that, but and
Hmm.
they will agree the labor market's loosening, and if this continues on too long, it's a problem. But things are moving slowly enough that, like, what's the big deal waiting 6 more weeks? We'll have more data. We'll either make it justifiable for us to make a decision, or alternatively, like, we won't be making a July decision and get 2 months of bad inflation data, and
Hmm.
or 2 months of like actually firmer labor market data, and say, wow, I wish we hadn't moved that soon. I think they believe, and I think not unreasonably, they have the time to make a decision without events outrunning them.
Hmm.
And I think it's a reasonable guess. I think, like, the way you characterize it is, is recession risk up a little bit? Probably. I mean, probably relative to a few months ago when the labor market looked stronger, but it hasn't gone up so much that you they feel safe balancing that slightly higher risk against what Allison talked about, which is you just don't want to be you made substantial progress on inflation. You're not quite there yet,
Hmm.
according to the PC price index data, and you kind of like you want to lock in those gains and not risk them. And I think they kind of feel like that balance of risk of waiting 6 more weeks or 7 more weeks is
Okay.
warranted. And I'm reasonably confident and really hope that they're right, because otherwise, man, whoever's doing this broadcast with you at that time is going to be a little more downbeat.
Okay. All right.
Yeah, and also, as I
Uh,
said, you wanna account for the fact that a surprise cut has more power than a non-surprise cut. So
mhm.
they don't they don't want the rate cut to really do anything to markets. They just want it to do less to markets. You know what I mean? So, you know, I that's why I don't anticipate any surprises, because then that would have a bigger expansionary poof. Like, that's what you want to do when you're in a recession. You want to, like, jumpstart
Yeah.
the economy again.
Sure. All right. So let's talk time horizon a little bit, right? Because uh, I often end up arguing the dovish case on on these live streams. I think I have pretty good basis for it right now, given the reported data in the last the reported inflation data over the past 3 months, given some forward looking things like the Bureau of Labor Statistics all tenant rent index. I think all of this is arguing that in the sort of near term, looking out three months, I feel pretty good. But there is another time horizon to consider, and that's the medium to longer term one. And we've got folks talking about global conflict, which people argue could be inflationary. You've got domestic issues, including the US election, where one candidate is arguing in favor of an extremely bold and unprecedented in recent decades tariff policy, perhaps a negative supply shock to the labor market. Is any of that a reason to hold rates where they are right now, Allison?
No, if like, in the perfect world, what the Fed should do if things go according to their plan, if
Hmm.
that was the case, is they gotta, like, bring inflation back down to 2 and then have a discussion about increasing the inflation target to 3. Because then if we do have this structural increase in inflation in the future, they can be like, "Oh, look, we're
Hmm.
still hitting our target." Anyway, they have no ability to really influence supply, like, sort of, shocks that might make inflation structurally higher. But they can't, this has been the sort of conundrum, is they can't lower the target, oh, sorry, increase the target until they've reached the target. Otherwise, it looks like we're just increasing the target because we can't do it. But if they're like, "Aha, we're strong. We got it back to 2, but now, economy's changing. We're gonna move to 3," then that seems better.
Okay, all right. But how does one manage those risks as an investor? Because you're like guys, my labor market guru. You're my risk guru. You wrote the book,
Mhm.
so uh, I'm looking at this as an investor. I'm looking at it where the Fed is sort of leaning towards cuts in the relatively near term, but they haven't quite made up their mind. In the medium term, there's this whole other set of risks. Obviously we can't predict the future, but how should we be managing those risks? Even as regular folks, like the retirees that you also specialize in.
I would hedge my duration, because that would mean a lot more interest rate volatility going forward. Because, as I said, just on the long end of the curve where the Fed has a little less power, if we're in a more uncertain inflation environment and a higher inflation environment, then we're going to have both higher and more volatile interest rates. So in that case, you want to think about, I guess duration matching maybe will make a comeback. And as I said, think about good hedges for a more volatile, like sort of in general, bond environment.
Okay. All right. But I want to get into shortly speed round on what we what we think Jay might say, or what he should say at this press conference, because the precedent here has been that we get the decision, we get the statement, the market sort of takes off in one direction, and the chair, who can be sort of loquacious by the standards of that particular office, has often managed to send the market in a completely different direction. I tend to love the Powell press conferences. I think that they do generate some volatility, but I think that it's generally in the service of transparency, which I think on the whole is a good thing. But before we get around to that, I did want to come back to this idea of the sort of stuck labor market, which I know you've thought a lot about, Guy. So one thing that I'm sort of curious about is, it seems like a tough labor market. As I said, it's great that people aren't getting fired for now. That means you're not seeing this sort of deleterious snowball effect in the labor market, where like declining earnings lead to layoffs, which leads to further declining consumption, and that can all get really bad for an economy relatively quickly. But this stuck economy isn't great either, I think, for people who are on the outside, maybe a recent graduate who's trying to get their first job. And my question to you, Guy, is like, how does something like this resolve itself? Does it need to get worse before it gets better, or do we just not know?
Well, I don't know how much worse it needs to get, given how much
Mhm.
progress the Fed has how much progress the Fed has made on its inflation mandate. I think that the Fed
Mhm.
might conclude, and I think we might hear from Powell that the labor markets, and he's already been saying the labor markets moved into much better balance. They don't really need. I mean, to the degree you believe that the labor markets are playing a big role in the inflation problem, which I think is debated, they might still not feel like they have to move that much more on this. We're very close to their year-end projection for the unemployment rate, so they might think we're in an okay spot, willing to wait and see. I do think the way to think about it is until the Fed becomes really confident we're 2%, they're going to want to keep a lid. I mean, they're going to want to create a floor under hiring, maybe, so it doesn't fall that much further. But they're all of a sudden they pulled some lever, surprised the market the way Allison sort of describes, and really juice it. And inflation starts rocketing up. I'm picking an extreme, almost straw man example. They're not going to like that, because they're feeling as if the market is labor market is close to balance and is appropriately tight. I mean, they said the unemployment is really low. They want to keep it there, but they don't want to have it coming back down. They're kind of, again, they're navigating this tight path where inflation's come back to 2% till they're really confident. And they don't want the labor market cooling too much, but they don't want it heating up again. And so I think what it suggests is, I think, sort of, for example, this frozen labor market could last for quite a while, because the Fed's not going to want, again, they don't want it getting worse, but they don't necessarily want it getting better. It's going to still be
Right,
tough to find a job for quite some time.
right. All right, but before we change gears to a little bit of speculation, a little bit of forecasting about what Jay Powell might say. So, a quick question from the YouTube channel, which I think we've sort of addressed here, but I'll let Professor Allison answer this more fully. So the question from YouTube is it wise for the Fed to be so predictable? So you want to expand on your answer from earlier? I think there are some trade-offs here. How do you think about this?
Yeah, this is like the central debate in monetary policy intellectually for like probably the last 50 years, is that if you're predictable, you have less power, but if you're unpredictable all the time, you have no credibility, and that's worse. So right now, it's actually being predictable is actually useful, because if you do unpredictable things, they have more of an impact. But you don't want to have an impact. You don't want to boost the economy. You just don't want to take, make it a little bit less restrictive. So right now, they want to be very predictable so they can maintain credibility. So if there is a recession, because there will be someday, I'm not saying when or how or is anything related to this, but someday they want to. They want that power to be unpredictable and have that boost. So you want to be predictable most of the time.
Right. Right. And to that point, like over history, there was a time several decades ago, if you go back to Greenspan and basically everybody before him, the Fed was like a black box, right? I mean, the things the Fed was doing filtered out to the public in a very sort of funky way. There was a whole cottage industry that grew up around basically interpreting the Fed's smoke signals. And today's Fed is objectively just way more transparent, way more communicative. And I think that's probably a good thing all in all. It probably brings down risk premia over a longer time horizon, but maybe it makes you a little bit less nimble in the near term. Do you think that's fair to say?
Well, we used to say that, and I believed that. Oh yeah, lower interest rates, no inflation, because the Fed's so credible and transparent. But I don't know. I think the last couple of years have made me question it a little bit, because they're being so transparent, but they're also wrong a lot. Like, I mean, there's been these years of like all their forecasts keep being wrong. So I think there's something to be said for the Greenspan approach, because yeah, I mean, you want to be transparent, but you also need to be credible and seem like you know what's going on. And knowing what's going on is unknowable. So no shame in that. But like, do you have to broadcast that you don't know better than everyone else?
Yeah. I think to add to that, John, because I like the way Allison stated it. Like they've there are two sources of unpredictability from the Fed. One is like the unpredictability of the data itself, and that is unknowable, unsolvable, unless you're crystal ball, which they don't candidly have. I mean, nobody does. And that part they can't solve, and they've sort of tried to contain unpredictability to that. Another one's dialing back the unpredictability of how policy reacts to those circumstances. That I think is what they've tried to dial down, but I think it's not. I mean, what Allison's getting at is maybe they've dialed. You could have those two like unpredictabilities moving the opposite direction, introducing stability to policy. And because they removed that buffer of reaction, that's why we're like in this data dependent mode that makes people freak out. Because the future policy seems to be wiggling around with each data point. And probably to some degree that's constructive. And I personally greatly appreciate it as somebody who follows this, but I don't know whether, I mean, I guess there are people that would argue that maybe it would be nice to have some unpredictability in the opposite direction, just buffering unpredictability of economic data.
All right. Well, listen. It's time for speed round. We've got 2 minutes, and then we're going to let you all go so we can watch Jay Powell and dissect his every word, overanalyze every single sentence, every blink, everything he does. Guy, to you, real quick, in 45 seconds, what do you still want to know? What do you want to hear from Jay?
How worried he is about the labor market, and how much confidence he's gained since the last meeting about inflation.
Okay. What do you think, Allison?
Well, just as someone who's just interested in monetary policy history and going forward, I'm just going to be watching for the little Easter eggs he drops about giving himself space to cut in September if he feels the need to.
All right. Well, we're going to leave it right there so that everybody can tune in to the Powell Presser. I want to thank Guy Berger, Director of Economic Research at Burning Glass Institute, Allison Schrager, Senior Fellow at Manhattan Institute and Bloomberg Opinion columnist. My name is Jonathan Levin. I'm a Bloomberg Opinion columnist as well. We do this for all the big eco stats and all the Fed meetings. So please join us again next time.